So welcome back. So in this video, we're going to cover the basics about put options, kind of define what a put option is and how they work intuitively. There's a very easy example you might be able to tell from looking at the image there I put on the slides. Give you a real world example of puts not in the stock market, but in real things, real assets. And then we'll go into the platform and kind of do an example or two of these with time permitting. All right, let's go ahead and dive into it. So what is a put option? The easiest way I like to think about put options, because some of these option contracts, they're kind of difficult to really understand at face value. I like to think of it as buying insurance. Now, it's not a perfect example of buying insurance, but it gets the point across very, very well. So let's think about what a put option is, kind of the definition of a put option is in the stock market first, and then we'll draw the analogy out over time to trading insurance. So in a put option, the owner of the put has the option to sell the stock that they hold at a specific price. Okay, so that's the definition. We'll drill that in. We'll make that make sense over time here. So let's think about it like home insurance. In the world of home insurance, you're paying premium every month, kind of like buying the option every single month. And you pray you never have to use it, right? Like that's one of those things you don't really like to pay for it, but you're darn sure happy that you have it if you ever do need to make a claim, or if you ever need to exercise the contract you have with your insurance company. So let me move my face out of the way here. But if your home ever burns down or floods or a tornado rips through it or whatever happens that causes you to need to use your insurance privileges, basically when your house burns down, basically you're saying the value is dropping significantly. It's going to zero, or it's dropping to such an extent where it's profitable for you to use your insurance option. So in that case, you can sell your home, kind of like selling your home. If you total your car, if your home burns down, you need to replace it and rebuild it. You're essentially selling it to the insurance company, and there's an agreed upon price. You have a coverage limit. They may need to do some surveys and whatnot, but essentially, when you're signing up for your insurance, you're signing up for a certain level of coverage where if these things happen, you can get that money back for the value of your home at the agreed upon price. So just like you're protecting the asset of your home by buying home insurance, the owner of an option on a stock, let's say the S&P 500, if he owns a good chunk of stock in the S&P, he may want to protect that holding. He may want to protect that asset from its value dropping significantly. So he could buy a put option on his stock, and he's kind of getting that insurance. He's getting that warm, fuzzy feeling of knowing that he's protected in case a huge bear market comes in and threatens to take half of his account value away from him. He can exercise his put option and sell his stock to whoever sold him that option at a price that they agreed upon. Okay? So it's all about protecting your assets when you're talking about buying a put. So what's in it for the seller? Because I don't like to buy puts all that often, but I do love to sell them. So just like the insurance company, there's money in the insurance game. That's why there's insurance companies. That's why you see commercials for Geico all over the place. What they're doing is they're selling risk premium. What that means by that is the numbers work themselves out. The actuarial tables are there in the background saying that, it makes sense to take on this risk of insuring this person's home on a number of different factors, because over time, I'm going to calculate out that I'm going to pay out a certain amount in collections and coverages or in claims that are coming in. That's going to happen over time. But the math works out with statistical probability that the premium you're collecting every single month from all the people you're insuring will more than cover for those large claims that come in periodically. And overall, and over time, your insurance company will boom, it will thrive, it will become profitable. So it's the same exact way in stocks. Ourselves, as option sellers, we are the insurance company in this example. We see the statistics, we see the probabilities. We know we're taking a risk, but we're being compensated for the risk that we're taking. And that's exactly the situation here. So let's go ahead and set up a put in Tastyworks. I'll use the web platform on this video. You can do this in the desktop, on the mobile, anywhere you like. But we'll go ahead and just show you an example or two of how this works, and you'll see both the buying and the selling side. So let me flip back over here, and let's go to the trade tab, and let's just put in, since we talked about SPY, let's go ahead and put this guy in, and let me clear out what I have here. Okay, so we covered how we read this table view of the stock market. This is called the options chain of this particular stock. So the current price of S&P is 277. It's up $2 today, which explains why everything else in the world is up and hurting my portfolio. So here, if we're talking about buying insurance, let's assume we're first a buyer of the put, because that is the easiest way to think about it. This is, you are the homeowner and you want to protect your asset. So yesterday we talked about the calls, which are on the left-hand side of the screen. So today we'll talk about the puts, which are, as you guessed it, on the right-hand side of the screen. So just logically, it's not going to make a ton of sense for you to buy a put above the price of the stock. And let's just think about that here. So what this is saying is that I'm going to pay you for the privilege to sell you the stock higher than the stock is currently trading. So let me put that another way. So I'm going to pay about $7, $6.91 for the privilege of selling you the S&P 500. I think that's what, $7 higher than the stock price is right now. It doesn't really make a lot of sense. You're not insuring against the loss, which is really the purpose of the put option. So let's go ahead and drag this guy down, and let's just kill him. And let's say instead you want to buy it here at 270. This one makes a bit more sense. So this is saying that I currently own the S&P at $277. But if, let's say, for example, if it drops down to $260, if it moves all the way down here, I have this protective put, is what they call it, a protective put that I paid $2 for. And if the stock price does drop down to 260, I have the right to exercise that put and sell my position at 270. So I'm locking in a pretty nice profit here, because it's worth 260. And I'm going to sell it at 270. I'm making, and I paid $2 for the option, so I'm making $8 in profit on that trade there, on that protection there. Now again, it's kind of a misnomer. You're making a profit, but if you think about it, you're really not. You're capping your losses, because you, at the time you purchased the option, you owned the S&P at 277. You're selling at 270, so you're still down, but you're dramatically reducing the losses you would incur. But if on the other hand of it, let's take it from the perspective of the seller. So now I'm going to sell the 270 put in the S&P, and let's take a look at the curve view to kind of explain how this one works. I'm going to zoom in. So again, on the curve view, this shows the probability, the distribution of the probability that the S&P lands on that price point at expiration 44 days away. So said another way, there's roughly a 50% chance it's going to stay right where it's at. That's how normal curves kind of work. But then as you go over this way, this is a 1 standard deviation. So there's a 68% of chance that the S&P is going to land between these bars, and a 95% chance that the S&P is going to land between these bars at like 252 and 303 maybe. But this is where the stock price currently is. So when you're a seller of the put, and let's say we sell that 270 put, we are going to collect $1.92 per share. So you're collecting $192 if you're selling one contract. And we can just see that by we go to review and send. You'll see you're making $192 by selling that. What that means is that so long as the S&P doesn't fall below that level, and you'll see it's actually a little bit further than that level, but so long as the S&P stays above 270, you're at max profit. You're going to make $192 at expiration, assuming you hold it all the way to expiration. And if the price drops below 266.40, we'll talk about the math in a second, you are going to start losing money, and that amount of loss is going to increase the further and further the S&P drops. Unlike buying options has unlimited upside potential. selling options does technically have unlimited downside potential, but you have to think about the probabilities there. I mean, what is the probability that the S&P is going to drop down? Again, this is still a very high level here, and we're at very, very minimal probabilities. It's all a numbers game. Just like a house can burn down completely, but what is the real chance of that happening compared to minor little claims here and there? So let's talk about this math real quick. Let's click on this little gray $sign. And what's great about Tastyworks is that it gives you these kind of helpful hints along the way as you're trying to understand things. It makes it very friendly for early traders. So here you go. If the price of SPY winds up being between 266.40 and 268, your profit is going to be somewhere between 0 and 160. So you're saying your break-even point is at this point here. So the math on that is you're selling the 268 put, and you're collecting $1.60 credit for selling that option. So if we do the math here, I'll bring this into view. You sold the 268 put, but you're not going to lose money immediately if it drops to 267.70 because you sold the 268 put. So the math on this is you take the strike price that you're selling, 268, and you subtract $1.60 now, which is where our price is. So your break-even point is 266.40, which makes sense, right? Like you're not losing money until the stock price drops in value beyond what you received in credit, that risk premium that you took in for selling it. So that's how you start to calculate your break-even point here, and everything beyond that goes down as the stock price moves down. So that is buying and selling puts inside Tastyworks, and kind of a brief little overview of how that works out. I hope this video was helpful. In the next video, we'll continue to go down understanding the basics behind options and options trading, and we'll start to get into the strategies and some of the tactics we can use to take all this foundational knowledge we have to understand, have to build into, and use that into future options strategies and an entire trading plan. Hey guys, thank you so much for watching this video. If you're on YouTube, go ahead and hit the subscribe button and click the little bell to be notified when I make my next video and send it out to you. But even better than that is if you want to have access to me live as I'm recording this and sharing my portfolio and the ups and downs of my options trading journey, go ahead and head on over to optionengineer.com/group and sign up right there to have instant access to my private Facebook group. It's awesome. There's so many great members growing every single day to become better, more profitable, more exciting options traders. So thank you guys so much for checking it out, and I'll see you on the next one. Take care.